Right now, something is unfolding in the gold market that almost nobody is interpreting the right way. Over the past 30 days, $11 billion has flowed out of gold ETFs in a single sweeping move. Turkey sold off 60 tons of bullion in just 2 weeks. Gulf sovereign wealth funds are removing physical gold from London vaults at a pace not witnessed in 70 years. And gold, the very asset that was supposed to rally during wartime, has dropped 21% from its January high. Every financial channel is asking the wrong question. They keep asking, why is gold falling during a war? I want to ask a different question. I want to ask, what is this creating? Because after 40 years of studying markets and debt cycles, I have learned one thing very clearly. The most important wealth events in history never look like opportunities when they begin. They look like crises, and right now, beneath all this chaos, 3 completely separate wealth windows are opening at the exact same time. I have not seen this kind of alignment since 1979. Stay with me, because I am going to show you exactly what I see. Here is what I want to walk you through in the next few minutes. First, I want to explain why gold's collapse is not what it seems, and why the mechanism behind it may actually be the most bullish signal I have seen in years. Second, I want to show you a sector that almost no serious investor is discussing right now, but where institutional money is moving in a pattern that mirrors one of the most reliable energy setups of the last 50 years. And third, I want to show you what I believe is the most structurally predictable wealth transfer in the history of the pharmaceutical industry, and why the clock on it is already ticking. These are not opinions, these are sequences. And understanding sequences is what separates the investors who build real wealth from the ones who simply react to headlines. So let me show you what is really happening in gold. When markets are hit by an oil shock at the same time, a central bank stays hawkish. A very specific chain reaction begins. Leveraged funds, the ones running complex multi-asset strategies, get trapped. They are long energy and short volatility. When oil breaks above $110 a barrel and the Federal Reserve signals it cannot cut rates because inflation remains too high, those funds get hit with margin calls. And when you get a margin call, you sell your best performing asset first. Gold had already risen 65% in the 12 months before this sell-off. It was the most profitable position on many institutional books, so they sold it, not because they no longer believed in it, but because they had no choice. And the data supports this. BNP Paribas Commodities Research notes that in 2008, 2020, and 2022, the last 3 major economic shock cycles, gold initially fell as investors sold their strongest performing holdings to raise cash. In every one of those cases, gold later recovered and pushed to new highs once the forced selling ran out. Here's what I want you to understand. $11 billion left gold ETFs in March 2026. That is not retail panic. That is institutions covering margin calls. The long-term reason to own gold, de-dollarization, fiscal deficits, central bank reserve diversification, has not changed. What changed was the technical setup. The price fell because of who was selling, not because of why gold matters. JP Morgan has kept its year-end 2026 gold target at $6,300. Deutsche Bank is at $6,000. Neither of them has reduced those targets. That gap between roughly $4,300 today and $6,300 is not just a prediction. It is a thesis about what happens once the forced liquidation ends. I have spent 4 decades studying debt cycles and geopolitical transitions. And when I look at what is happening right now, I see a pattern that appears again and again at major inflection points. The pattern is simple. Moments of maximum confusion create the widest gap between price and value. And right now, that gap exists in 3 different places at once. The investors who understand the mechanism, not just the headlines, will be positioned before the crowd realizes what is happening. Let me take you through each one. But first, if you value this kind of system-level analysis, subscribe now. Subscribe now. Now let me be precise about what forced selling actually means, because most people use that phrase without understanding the mechanics. When a hedge fund runs a leveraged portfolio, let's say 3.1 leverage, and the value of its book falls by 33%, that fund is effectively insolvent. The broker calls. Cash has to be raised immediately. At that point, they are not asking what looks cheap. They are asking what can be sold quickly. And the answer is always the same: the most liquid, most profitable position on the book. In March 2026, that position was gold. Turkey gives us a perfect example of what emergency liquidity looks like at the sovereign level. The Turkish lira hit its 11th straight record low against the dollar during the 16 trading days after the Iran conflict broke out. The Central Bank of Turkey holds more than 111 tons of gold at the Bank of England. Bloomberg reported that officials were considering borrowing against that bullion to defend the lira. In the meantime, they sold roughly 60 tons into the market. India turned into a net seller. Gulf sovereign wealth funds, ADIA, PIF, and others whose transactions are not publicly disclosed, appeared in London bullion market data as a 45-ton outflow above the normal average. Here is what I want you to write down. These entities did not stop believing in gold. What they needed was dollars, emergency dollars, to pay for oil that now costs 40% more than it did 60 days ago. They are selling family silver to cover a temporary bill. And here is the mechanism that follows, again and again, in every cycle I have studied. When the emergency ends, when oil stabilizes, when pressure on currencies eases, those same buyers come back. And they do not come back slowly. They come back urgently, because their reserve diversification mandate still exists. The World Gold Council forecasts that central banks will buy roughly 850 tons of gold in 2026, almost the same pace as last year. The buyers never disappeared. The sellers were temporary. Now silver tells a different story, and in some ways a more interesting one. Silver has two demand engines that gold does not: investment demand and industrial demand. In 2026, silver has entered its fifth straight year of industrial supply deficit. Solar panels, electric vehicles, AI data center infrastructure. These are all inelastic buyers of silver. They do not care what the price is. They need the metal to build the machinery the global economy depends on. And yet silver is still trading well below where industrial fundamentals suggest it should be. The gap between paper silver, futures contracts, ETF shares, allocated accounts, and physical silver has become one of the defining structural distortions of the last decade. I have watched that distortion build for years. At some point that gap closes. It always does, and when it closes fast. The structural bull case for both metals is still intact. What changed was the price. And in the short term, price is set by the most desperate seller in the room. Right now, the desperate sellers are the ones in control. That window does not stay open forever. Now this next part surprises a lot of people, and I understand why. Coal is not a word most people associate with opportunity. For the last decade, it has been associated with decline, environmental mandates, ESG pressure, and pension fund exclusion. Institutional capital has spent years avoiding it. Coal mining companies have been starved of investment, and that is exactly why it interests me. Let me explain the mechanism. When Brent crude moves above $100 a barrel, it changes the economics of every competing energy source on the planet. Utilities do not make ideological decisions, they make mathematical decisions. And when natural gas prices surge because LNG supply chains are disrupted, as they are right now with Qatar Energy declaring force majeure on long-term contracts after attacks on the Ras Laffan facility, utilities start looking for the cheapest substitute available. That substitute is coal. In Europe right now, It is cheaper to run coal-fired plants than gas-fired plants. That is not a political statement. It is simply a pricing relationship. European utilities are rebuilding coal inventories for a burning season that could last longer and be colder than analysts expected just 3 months ago. In India, the setup is even more structural. Energy Statistics, India 2026, published by the Union Ministry of Statistics, shows that coal still provides nearly 79% of domestic energy, even while solar and wind capacity continue expanding rapidly. India's coal production surpassed 1 billion tons in fiscal year 2024-25. Coal consumption is projected to grow another 2.5% in 2026. India imports nearly 89% of its oil, which means every oil spike becomes an energy emergency for planners there, and their response is always the same: maximize domestic coal production. In the United States, the current administration signed an executive order in April aimed at reviving domestic coal output, including environmental regulation waivers for existing coal plants. The result has been higher U.S. coal demand forecasts for 2026. Here is what the investment setup looks like. A full decade of ESG-driven divestment has crushed capital expenditure across global coal mining. Supply has shrunk. Now demand is rising, not because the world changed its values, but because the world changed its energy prices. That combination, constrained supply meeting rising demand, is exactly the setup that creates the strongest commodity price moves. I am not saying this is a 50-year investment. I am saying it is a cycle. The cycle was created by capital avoidance. It will eventually be resolved by capital returning. And between those two moments, there is a trade. Coking coal, the metallurgical coal used in steelmaking, has its own separate demand driver, and I find that equally compelling. Every major defense spending surge in modern history has required steel. Ships, tanks, artillery systems, fortifications, they all depend on it. The United States, Europe, and their allies are all committing to multi-year defense spending increases right now. Major bank forecasts put coking coal in a range of $215 to $220 per ton through 2026 and 2027. You cannot build ships without steel. You cannot produce steel without coking coal. That supply chain is not optional, and institutional money is already moving. Coal India, the state-owned giant and one of the world's largest producers, is up 11.3% year-to-date in 2026, while the broader Nifty 50 index is down 6%. That divergence is not random. That is capital rotating into a sector most investors were told never to touch. I have seen this setup before. In 1999, technology was the consensus growth trade. Energy was the consensus avoid. By 2005, energy had outperformed technology by an order of magnitude. The mechanism is not identical today, but the structure rhymes. Consensus avoidance creates supply deficits. Supply deficits create price spikes. Price spikes create profits for the people who positioned early. Now let me take you to the third window, the one I believe is the most structurally predictable of them all. And when I say predictable, I mean something very specific. I mean that the events driving it are already on the calendar. The dates are known. The revenue figures are published in annual reports. Here is the setup. The global pharmaceutical industry is heading toward the loss of patent protection on roughly $300 billion in annual drug revenue by 2030. This is not speculation. This is a list of drugs with known expiration dates. Keytruda, Merck's immunotherapy cancer drug, generated $29.5 billion in 2024 and is projected to peak at $32 billion in 2026. Its core patent expires in 2028. When a biologic loses patent protection and biosimilar competition arrives, revenue can fall as much as 80%. Eliquis, the blood thinner co-marketed by Bristol Myers Squibb and Pfizer, loses U.S. patent protection in 2028. It produced $13.3 billion in combined sales. BMS faces the steepest proportional patent cliff among major pharmaceutical firms, with 47% of its revenue at risk by 2030. Ozempic and Wegovy, Novo Nordisk's semaglutide franchise, generated a combined $26 billion in 2024. International patents begin expiring in Canada, India, Brazil, and China in 2026. These companies know this. Their boards know this. Their bankers know this. And they have one main response: acquire. Pharma companies cannot create a new blockbuster in 2 years. Internal drug development typically takes 10 to 15 years and costs around $2.2 billion per asset. They do not have that kind of time, so they buy what already exists. Stifel Securities estimates that major pharmaceutical companies now have $1.2 trillion in combined M&A firepower. Total pharma M&A value hit $240 billion in 2025, up 81% year over year. In the first 2 weeks of January 2026 alone, $9.2 billion worth of deals were announced. Leaky Consulting projects more than 20 acquisitions over $1 billion in 2026 alone. Here is the investment mechanism I want you to understand. Large pharmaceutical companies are hunting for smaller biotech firms that already have promising drug candidates in development. When they identify one and acquire it, they usually pay a substantial premium over the market price, 30%, 50%, sometimes even 100% above where the stock was trading before the deal. If you are invested in the right biotech before that takeover happens, you capture that premium. The real question is not whether this happens. It is already happening. Deals are being announced right now. The real question is whether you understand the pattern well enough to position ahead of it. Now let me be very clear about the risk profile. Biotech has a high failure rate. Clinical trials fail. FDA approvals get delayed. Individual companies can absolutely go to zero. This is not a sector for concentrated bets. If there is any appropriate exposure here, it is diversified exposure. Broad biotech ETFs like XBI or IBB, which provide access to hundreds of companies at once, or large integrated pharmaceutical firms that are already navigating the patent cliff through acquisitions and reformulations. What matters most to me about this moment is the combination of forces arriving together. The patent cliff has created a buyer with a $1.2 trillion checkbook and a deadline. AI-driven drug discovery is compressing timelines. What once took a decade may now take only 3 years. And the biotech sector itself, after bottoming in spring 2025, has already rebounded 75%, creating a valuation backdrop where buyers and sellers can actually agree on price. The wealth transfer from big pharma balance sheets to biotech shareholders has already started. The acceleration is already scheduled. The dates are in the annual reports. Now let me bring these 3 windows together and tell you what I actually believe. The sell-off in gold and silver is a forced liquidation event, not a fundamental shift. The structural buyers, central banks, long-term investors, de-dollarization participants are still there. Price has moved away from value. That gap will close. It has closed in every previous cycle. The move back toward coal is what happens when supply starvation collides with recovering demand. It is not a permanent reversal of the energy transition. It is a cycle inside a broader trend. And cycles, properly understood, create returns. The biotech patent cliff is the most mechanically predictable opportunity I have seen in any sector in the last decade. The demand for acquisitions is measurable. The pool of acquirers is known. The timeline is public. The only unknown is which companies get bought and at what price. And what connects all 3 is a concept I have returned to throughout my career. The difference between price and value. Price is what the market assigns right now in this moment under current stress. Forced sellers, panic, margin calls, oil shocks. Value is what the asset is worth once conditions normalize. And the distance between price and value is where wealth gets created. It is never comfortable. It never feels good. The moments when price and value are most disconnected are always the moments that feel the most dangerous. In 1979, gold fell sharply as the Federal Reserve under Volcker raised rates aggressively to fight inflation triggered by an oil shock. Most investors sold. The ones who held, or bought, saw gold rise more than 200% over the next 3 years. I am not predicting an identical outcome. I am pointing to an identical mechanism. When you understand the mechanism, you do not need to predict the exact outcome. You need to understand the sequence. And the sequence right now is forced selling, exhaustion, the return of structural buyers, and price recovering back toward value. The 3 windows I have described tonight are open. They will not stay open forever. The investors who understand what is driving them, not just the headlines, but the mechanics underneath them, are the ones who move before the crowd catches up. Now let me close with where the numbers stand today. Gold is trading around $4,300, down 21% from January's $5,596 high. JP Morgan's year-end target is $6,300. Deutsche Bank's year-end target is $6,000. That implies roughly 46% to 67% upside from current levels, assuming the structural thesis proves correct. Silver is in its 5th straight year of industrial supply deficit. The paper-to-physical ratio is stretched. Historically, silver's rebound tends to follow gold's, but with amplified upside. Coal India is up 11.3% year-to-date against a falling broader market. Coking coal is forecast between $215 and $222 per ton through 2027. Defense-related steel demand is structural and multi-year. Biotech, $1.2 trillion in pharmaceutical M&A firepower, more than 20 acquisitions above $1 billion projected in 2026, $300 billion in patent-exposed revenue by 2030. The clock on this wealth transfer is already ticking. These are not recommendations, they are data points. What you do with them depends entirely on your own financial situation, your time horizon, your risk tolerance, and your judgment. But the data is what it is, and I want to leave you with one final thought. In every major cycle I have studied, there are 2 kinds of investors at the inflection point. The first sees price falling and assumes the thesis has changed. They sell or they stay away. They wait for certainty before they act, and by the time certainty arrives, the move has already happened. The second type asks a different question. They ask, why is the price falling? Then they determine whether the answer reflects a real change in value, or simply a change in who is selling and why. Right now, the answer is forced selling, emergency liquidity, margin calls, and countries paying oil bills with gold they would rather hold. The value of the underlying assets has not changed, and the investor who understands that difference has an advantage, but not for long. Markets are efficient over the long run, but in the short run, they become deeply inefficient precisely during these moments of maximum confusion. This is one of those moments. 3 windows. 1. Gold and silver, where the gap between price and value is wider than it has been at any point in this cycle, created by forced liquidation that has nothing to do with the structural reason to own them. 2. Coal, where a decade of ESG-driven supply starvation is colliding with a demand rebound driven by the biggest energy shock of a generation. 3. Biotech, where $1.2 trillion in pharmaceutical buying power is chasing a pipeline problem that cannot be solved internally, and where the timetable is already written in patent expiration tables that every major pharma board has seen. I have spent 40 years watching these cycles. And again, the windows that look the most dangerous are often the ones that create the most durable wealth. The sequence is already in motion. Whether you act on it and how you act on it is your decision to make.